holding my breath and I'm ready to go. I'm falling right in and I'm ready to go. I found what I want and I know that we're on top, so I'll tap in and I'm ready to whoa.
Broadcasting from Central Kentucky, the headquarters of the Dr. My Budget podcast, where we discuss how to grow your personal wealth without having a major impact on your current lifestyle. Here is your host, Dr. Dan, the Finance Man.
Welcome, everybody. Today is Monday, April the 17th, 2023. Hopefully you have your taxes done because tomorrow is tax day. I'm your host, Dr. Dan, the Finance Man. And in today's episode, we will be discussing various topics related to mortgages that can help you make informed decisions whenever you're trying to buy or refinance your home. Today's episode is sponsored by Nexa Mortgage, NMLS ID 2296654. If you're thinking about buying or selling a home in the near future, we've got a team of professionals in both the mortgage and real estate industry. No matter where you're located, they can give you all the information you need so you can make the best informed decision on how to move forward. To learn more, you can reach us out at Dr. Dan at drmybudget.com. You can also call or text us on the Make Kentucky Home Group at eXp Realty phone line at 859-429-0552. We'll answer your questions and comments. So let's dive in. To start, let's begin with the basics. All right, I know this doesn't sound too exciting, but stick with me. We're going to break down the basics of a mortgage in a way that will make it as fun as possible. And we, hopefully more fun than a root canal. And hopefully you'll learn something along the way. At least you'll have a better understanding. So a mortgage is a fancy word for a loan that you take out to buy a property, such as a home, duplex, etc. It allows you to spread the cost of the property over a period of time. Typically, it's 15 to 30 years, although there are you can go 5, 10, and even 40 years in some instances, and pay it off in monthly installments. So when applying for a mortgage, how can I put this? It's a lot like getting a physical. So if you've ever played sports, you know exactly what I'm talking about. You have to go to the doctor, you got to get checked up, and they check you from head to toe to make sure you're able to participate in whatever sport you wanted to play in. Now, me, I didn't get so lucky. My mom refused to let me play sports, so she thought I would injure myself. And because she was a single mom and wouldn't be able to afford the doctor bill, I kind of get it. So I got the luxury of playing chess and doing things that involve using my brain. So I know we're getting off track. So whenever you apply for a mortgage, it's just like getting a physical on your overall financial situation. You'll need to provide certain information such as your income, credit score, and other financial details. And this is standard advice you can get on most websites if you just Google. And I know that you're here for the deep dive. So let's just break it down in reality. So what if I told you that the majority of your life, you've kind of been growing up living a lie? And it's not really a lie. It's more of like, well, this is the way it's always been done. And so let's get things straight. So when you're on that mortgage, that 15 to 30 year mortgage, that was created back during the Great Depression. And they did that to make homes more affordable because people didn't have a means to pay off loans quickly because, during the Great Depression, not a whole lot of funds going around. Sound familiar? If not, stay tuned. It's going to get a lot better. So then you were on a fixed rate, and then it was amortized. And amortized is a fancy term meaning to die a slow death. So you take out this loan that's 15 to 30 years, and it's going to die slowly over that period of time. Well, you're taught to go out and you got to study hard in school so you can get into a good college. And then when you get a good college, you got to work hard so you can have a great career and get a good job. And then, so you're taking on all this debt because student loans have went through the roof of what it costs to go to college nowadays. So now you're looking at that and, hey, I want to start a family. I want something for myself. I'm tired of paying rent. So now I'm going to go get a mortgage. And when you're getting a mortgage, you got to look at a fixed rate. And then they go and they shop around on who has the best rates. Well, here's the thing. Here's the reality. The bank's laughing at you when you're looking at an eighth of a point or a half of a point or even a full point. It's all just a gimmick. It's all a sales technique. Here's what goes on. Because when you ask someone to explain, well, what does it mean to get a fixed rate? Most people are like, well, it's my interest rate. I got to get a good interest rate. And are interest rates good and bad? It depends on what situation you're in. Is it always great to get a 30-year fixed? Maybe not. It depends on your situation. And I'm not saying that the tools that are out there are bad. You just need to understand where most of your money is going, because this is a Dr. My Budget podcast, and realize that on average, most consumers will refinance their home every 4 to 5 years, depending on if rates are better or what they've got going on in their life. And then they're going to move every 7 to 10 years. So if you're going to move every 7 to 10 years and you're going to refinance every 4 to 5 years, does it really matter what the interest rates are? I mean, to an extent, yeah, but over the long term, no, because you're just going to refinance or sell that home anyway. So this is what I want you to understand. Whatever your mortgage is, whatever home you're looking to go and buy, I want you to take that rate. And a great website that you can go to is uscalculator.org. And in fact, while we've got that, I'm going to pull that up so you all can see. So hold on just a second. Let me get this in. We're going to share my screen so you all can see this. Here we go. So this is a great website. It breaks down taxes, insurance, and PMI. So PMI is primary mortgage insurance. It's basically extra insurance that the bank takes out to make sure that you don't default on the payment. But this is where it gets interesting. So the average home price right here in Central Kentucky right now is about $250,000. And let's say, well, I don't have any money to put down. I'm going to get it on a certain loan program, which there are loan programs that are 100% at 200. So we're going to mortgage the full rate, and then interest rate, 6% is a little low. You're probably looking in around 7.25. We're not going to worry about PMI. We're not going to worry about the rest of this stuff. So what I'm interested in right now is your monthly principal and interest payment. So your principal and interest, that means your principal is how much is going to pay down your loan. Your interest is how much you're giving away to the bank. So that's $1,705.44. So we'll just put 17. We're going to, for sake of discussion, down to $1,700. Again, all this stuff is made up. So I want you to pull out your little calculator on your phone, and keep in mind 1,700. So pull out your little calculator on your phone, and we're going to pull mine out. So we're going to buy a house at $250,000, and then we're going to times that by 7.5%, and you should get $18,750. If you've got that, comment below, hey, yes, I got that. So everyone understands that so far. That is the interest that you're paying on your home on an annual basis. Now, we're going to divide that by 12. That gets our monthly payment. So $1,562.50. So that's how much you're paying in interest to the bank. That's not going to you. That's going to the bank. Let that sink in for a minute. So we said we're paying, let's just go on and put the 1,705 in there if you want to do that to keep your numbers accurate. So that means I'm paying $142.50 towards my actual loan. The rest of that went to the bank. Now, I don't know about you, but when I hear that, that gets me angry. And here's the thing, they're not trying to scam you. They're not trying to pull the wool over your eye or any of that stuff. It's all disclosed. All you're convinced to worry about and what you've been taught over the years is just to worry about your monthly payment. As long as I can hit that budget number, then we're good. Why should I have to worry about anything else? If I can live within my means. But here's the thing, you're paying that payment, and let's just call it what it is. 5/6 of that money, or almost 90, let's just call it 99% of that money is going to the bank. Now, if you knew that, you'd never take out a loan on those terms. So what's the alternative? Well, okay, so what we need to do is figure out a way to get more towards principal, which is going to save us thousands of dollars on the back end of that loan. If that makes sense and sounds like something you'd like to learn more about, comment below. I'd love to have some comments going on here. You can also call in and text us again on the Make Kentucky Home Group at EXP Realty at 859-429-0552 and chime in your thoughts and comments. So just, if you take that, what do we say? That 1562.50, and you multiply that out over the first year alone. I mean, I don't know about you, but if I had an extra 1562 a month, I could do a lot more than what I could now. And if that doesn't make you angry, and that's why the rich stay rich, the poor gets poor. The middle class is starting to go towards the poverty class. And nobody wants to talk about that. So, before you apply for a mortgage, it's important that you have a solid understanding of your budget and how much house you can afford, because the last thing you want to do is become what we call house poor. And when you become house poor, you're trapped in that house. So if you want to take a trip, guess what? You're taking a trip to the kitchen. You want to go on vacation, your vacation is your lovely backyard if you have a backyard, and you get to enjoy that. You want to go out to eat, you want to go do something fun, you want to take a trip, guess what? It's not happening because you are house poor, because you bit off more than you can chew, because you're trying to keep up with the Joneses and your neighbors, and this certain portrayal with your friends that, hey, I'm rolling, when you're really not. And you want to consider your monthly expenses, your debts, any future financial goals. A general rule of thumb to keep in mind is housing costs include your mortgage payment, property taxes, and insurance. And you need to keep that. The target number to get you magically approved is 30% of your income or below. So you want to qualify for the best rates. You need to have a great credit score, which we're going to talk about a little bit later on in the show. We're going to talk about, right now, how do you keep your debt low? What are the things that I can do right now that's going to affect my budget and keep me from paying this exorbitant, interest to the bank? So here's a simple statistic. On average, if you pay just an additional $30 more per month, and depending on what your rate is and things like that, but on average, that would knock about 3 years off the back end of your loan. So now we're taking a 30-year and we're now got it down to 27. just by paying an extra $30 a month. Well, how do I get an extra $30 a month? Well, maybe if you went to Starbucks one time less a week, you went out to eat one time less a week, you would have a lot more. Does that make sense? Do you, is this starting to sink in? If it is, comment below. I'd love to read the comments. And yes, I plan on responding to every single comment that comes the way. So here's some simple things that you can do right now without changing your total lifestyle. And first thing is, when was the last time you actually shopped for insurance? I know it's not a sexy thing to do. It's not like going out and shopping for the latest iPhone or the latest car or, something like that. It's insurance, but we all got to have it, right? So if you got to have insurance, then shouldn't we shop for the best rates? Well, so I can either go to my insurance company or I can actually use a broker. And a broker actually gives you a little bit more options, like all the big companies that you see on TV. It's not saying that they don't have better rates. They all have different rates. They all base that kind of somewhat on your credit score, but that it's also, good driving record and things like that can help lower those costs. Shopping around for that. And actually, we have a live caller. Welcome to Dr. My Budget show. I'm Dr. Dan. How can I help you?
Hey, Dr. Dan, this is Ava from Louisville, Kentucky. Thanks for having me on the show and taking my call.
Okay.
Me and my boyfriend are looking to buy a home. We both met in college, and it's just really hard to buy a home right now. Can you help us?
All right. So what you're telling me is you're looking to buy a home.
Yes, correct.
And
we met with this lender guy, and he said we needed more work history and that he wouldn't be able to get us qualified right now.
How long have you been at your current job?
About 3 months. We work in sales, so we get better offers from other companies.
That's the problem. We don't need to go any further. So what you need to understand is the fact that you're jumping around from job to job.
Okay.
And you're not having stability.
Really?
So when a mortgage company is looking to give you a loan or a mortgage, they're looking for someone that they believe is going to have a stable income. And I'm not saying that you're not having a stable income, because you're staying in the same career field, but you're bouncing from job to job. So you need to stay there for a minimum of at least 9 months or longer. When most lenders like to see at least 2-year job history. And when you bounce around from job to job, yes, you're increasing your pay, but in their eyes, they're looking at it like, okay, well, are they even going to be here? Or what happens if they can't find their next job and they don't get that? Does that make sense?
Yeah, it does make a lot of sense.
So my advice would be, first of all, whatever you're at now, look at staying there for at least 9 months. It can be longer. And then when you have that, then we can look at, getting you linked up with the lender and getting you moving forward and buying a home. So I know that's not what you want to hear, but at least you got some great advice on how to move forward. Does that help?
Yeah, like you said, it's not what we want to hear, but we do appreciate the advice. Thanks for your help.
Hey, you are more than welcome. Thank you for calling in to the Dr. My Budget show, and enjoy the rest of your day.
Thanks, Dr. Dan.
Okay,
you too.
So getting back to where we were, and we were talking about, going around and shopping for car insurance. So, keep in mind when you buy a home, you're also going to have home insurance. And when you bundle those things, your home and your auto, you can usually get a discount. So using a mortgage broker, they have more options and access to more programs versus like your, State Farms and those where they have set programs that the company offers, but you don't have much leeway there. If that makes sense, go ahead and drop it below. So, we talked about a mortgage. We talked about one thing you can do. Now we're actually going to talk about a first-time home buyer. And so, first-time home buyer, the process of buying a home can seem completely overwhelming. You've never done this before. And yes, you can get some research and you can prepare for it, but it can also be a lot of stress that is added onto you. It's why you need a professional to help you. You're about to go make one of the biggest purchases in your lifetime to date. And wouldn't it be nice to have someone that's on your side that's looking out for your best interest? And if you are interested in learning more about this, again, you can email us at drdan@drmybudget.com. We can link you up with a professional in your area. So there's certain things that you want to consider as a first-time home buyer. It's like, what kind of loan program do I want? Here in Kentucky, we have, the FHA, which is a first-time home buyers program, accompanied with down payment assistance through Kentucky Housing, which can make it really affordable. But keep in mind, when you take that down payment assistance, you're taking out a second loan. And we talked earlier about, the interest rate and things like that. So here's what you need to understand. Any extra money that you have should be thrown at your home mortgage. Yes, your credit cards and all that stuff matters. And yes, we need to keep those down. We'll talk a little bit more about that later. But your home is what's keeping you poor, your home mortgage. It's what's keeping you from getting ahead, because you're giving all your extra money to the bank. And the banks in the mortgage industry don't want you to know that. Your loan officer, I'm not saying that they're a bad person, because they're not. Most loan officers are trustworthy, but every industry has their bad apples. So it can't be that they're out to get you. It simply must mean that they just don't understand this, or they don't care to educate themselves on this aspect. But this is what's going to help you the most, isn't it? Having that extra $1,500 in your pocket every month goes a long way. It can help you do a lot more things. It can help you buy a lot more assets that you can then grow your wealth later on. And that is the whole purpose of Dr. My Budget. Why I created this show was simply to help you get the information you need so you can decide how to move forward, and then connect you with local professionals in your area that follow our core values. Core values are real simple. They've got to be looking to educate first. And I'm not saying that you need an education, but a lot of you do need an education, because this stuff isn't being taught in schools. You didn't know that if you paid an extra $30, that knocks about 3 years off your mortgage on the interest side. You paid off 3 years sooner. And, $30 doesn't seem like a lot, but over the course of time, it can really add up. It reminds me of the story of, the wealthy father that was getting ready to pass. He had a terminal illness, and he had two sons, and he told one son, hey, I can give you $1 million now, or you can take a penny, and that penny will double over the next 30 days. And, the one son thinks about it, and he's like, you know what? I could really use that $1 million right now. I'm going to take the money. So the other son, he's not like financially set, but, he's getting by. And he says, okay, well, I'm going to take the penny. And so which one actually comes out ahead? Well, the interesting part about this story is that if you double the penny for 30 days, where does that lead to? It starts off very small in the beginning, because, on day one, you get a penny. On day two, you get two. And then day 3 goes to 4. And day 4 goes to 8. And this is where it starts to get interesting. So on day 25, you already have almost 168,000. And so at this point, you're thinking, okay, well, maybe I didn't come out ahead, and I should have taken the $1 million. However, you've heard the story, good things come to those who wait. So on day 29, if we follow the math out, he has almost $2.7 million. It 2.68 mil and some change. And then on day 30 is where he gets paid a little bit over $5.3 million. So while it might always seem to be like, okay, let's take the million because that seems like the larger amount, it's the hidden stuff that grows wealth over time, which brings us back to this whole amortization period that we talked about earlier, to die slowly. Well, instead of, the bank sitting there getting rich, well, what if the bank didn't get rich? What if you started to do other things with that money? And that's stuff that we'll talk about in later episodes, but I want you to start to figure out that your mortgage is a great thing. It's something that you must have, because ownership in a home is, one of the biggest wealth building assets that you can have. And just got a text in that says, yes, they appreciate what I'm saying. Looks like this is John from Lexington. So John from Lexington, thank you so much for chiming in. Glad that you are hearing the message and, starting to realize that, the whole mortgage industry, the banks, the real estate agents and stuff, they don't know any better. So they want, they're just doing their job. They're trying to make ends meet. But as it's always been said, the riches are in the niches. For those that don't understand this, how much more like freedom do you feel knowing that if I just increase my monthly payment by $30, that I'm going to pay off like 3 years of my mortgage a lot sooner? And that should be an uplifting message. And that's just one aspect. We have multiple other aspects that we can use to increase that $30 to a lot more. And again, if you'd like to find out more, feel free to email Dr. Dan at drmybudget.com. And that brings us to our next segment, which is talking about refinancing. So as I mentioned earlier, on average, most people let's try that again. I got tongue-tied, that happens sometimes. So people refinance every 4 to 5 years. So here's what happens when you refinance, because some people do it to lower the monthly payments. Some do it to shorten the term on their loan. They pay off additional debt that they've accumulated, or whatever the reason is that you've decided that you need to refinance. Here's what happens. So that 30-year clock that you were working on, it resets back to day zero every time you refinance. And so while you're thinking about getting ahead, well, guess what? The banks and the mortgage industry, they're getting ahead too. And as we showed earlier, they're getting ahead a lot faster than you are. So my advice is should you refinance? Should you not refinance? Again, it depends on your situation, but just keep in mind that when you do that, that interest clock resets back to day zero. So that brings us to credit cards. And, credit card debt it's crazy. I was reading somewhere, where was that article? Yeah. So this was an experience study that took place in September of last year. And it said the percentage of Americans in debt depends on what type of debt is being reported. According to the Urban Institute, more than 64 million Americans carry credit card debt. And then that same study also found that 340 million of Americans are currently carrying some form of debt. Here's the thing. Debt is not a bad word. I know that there are some gurus out there that want you to live in poverty for the next few years so you can enjoy life and live the life that you are accustomed to or deserve to live. Well, here's my problem with that. What's the guarantee that you're going to live that long? Didn't think about it like that. And for some, those gurus are out there, those people need that. And I'm not discounting anything that they've done because I respect that they are trying to better the world. They are trying to make it better. And yes, there are people that have accumulated way too much debt. I'm not arguing that. That is totally a valid point and something that really needs to be addressed. My problem is there's no guarantee that you're going to see tomorrow. You could go home today and something happen, heaven forbid, and the lights go out forever. I mean, it happens every day. We read about it. And what I want to focus on is little things that you can do right now that don't impact your lifestyle in a major way, that make a big difference on the back end, like the penny that doubles over the next 30 days. So when it comes to credit cards, this is my advice. And the mortgage industry says that you should carry no more than 30% across your cards. So whatever you're allowed, your balance, what's the max on your credit cards? I got a $2,000 budget. Okay, well, if I've got a $2,000 budget and we take 30% of that, that comes out to really simple math. Means that I should have no more than $600 in debt. So I should have a $1,400 cushion there and only use $600. Okay. That's great, but what if I already have maxed out my credit cards? What if I'm sitting here on all of this debt and that extra $30 a month, because our interest rate on our credit cards are almost 30% or higher, or at least in the 20s. Some are lower depending on if you've got good credit or not. But I've got maxed out credit cards, Dr. Dan. What can I do about that? Well, that extra $30, I would devote that to your credit cards. Because while the mortgage industry says you need 30% or lower to get to that elite level in your credit score, you need to be at 10% or less. And I know some of you are like, well, Dr. Dan, how do I ever get to 10% or less? It's real easy. How many of you have some kind of streaming service? Netflix, Hulu, Disney Plus. Well, what if you just had a credit card and that's all that credit card went to? So I've got my streaming account on one credit card. That's the only credit card that gets touched. And that's the only charge that goes on that card. And that's a monthly charge that I know I'm going to pay off every single month. The problem that we get into is that most of us max out our credit cards and then it's too overwhelming and it feels like a burden to pay that off. So we overextend on credit that we don't need. So the easiest thing to do is have credit cards set up for different expenses, similar to the way that you would divide out your ledger if you had a profit and loss statement. So I've got one credit card that's devoted to paying my credit bills, or, not credit bills, but my streaming service. I've got another credit card that goes to nothing but gas. I've got another credit card that goes to groceries. And then I never borrow more than I intend to pay back every single month. And instead of me writing a check or me pulling out cash and paying with cash, now I'm just using my card and I'm paying that off every single month. When you do that, that's going to cause your credit score to skyrocket in a very short period of time. And do things happen? Does life get in the way? Absolutely. But if you keep your balances low enough to where you can manage them, then you're much better off than going out and maxing out your credit card and then wondering why your credit score is shot. Well, I didn't tell you to go max out your credit card. You made that choice. And the problem is that we live in a society where we don't want to take responsibility for our actions. We just want the benefit. We don't want to face the repercussions of that choice. And that's kind of where we're at now as a society, is that no one holds anybody accountable for anything. And then we wonder, well, what's wrong? Well, we have all this going on because no one wants to be accountable for anything. I want to go out and have the latest car, the latest iPhone, the latest whatever it is, clothing style. And then I want the house too. Well, it doesn't work that way. And then when you're told that it doesn't work that way, everyone loses their mind and no, I'm oppressed, I'm being discriminated against, woe is me. Well, no. Here's the thing that you need to realize. You are the only one that can get you out of your current situation. Yes, we can give you as much advice as it takes for you to get ahead. But if you don't make that choice and you don't follow that, is that my fault or is that back on you? See, if things are not going the way that you want them to right now in your life, the only one that can change that situation is you. No one else can do that for you. We've talked a lot about different ways that you can get ahead in this world, just by making simple changes. So I hope that you have found some of this helpful. And if you found this helpful, I would appreciate it if you like, subscribe, comment, share this podcast wherever it is that you get your podcast. And again, thanks for tuning in to Dr. My Budget. Hope you have a great week and join us next time where we're going to start talking more about home appraisals and, some more tips that you can do to lower that budget so you'll have more for later on to enjoy.
Holding my breath and I'm ready to go. I'm falling right in and I'm ready to go. I